Hello, my name is Paul Sippil. I am an independent registered investment advisor and fiduciary, primarily focusing on the retirement plan market. I, unlike a commission-based broker, provide advice directly to my clients and do not receive any compensation from any third party. I act in a fiduciary capacity, which means that I am subject to the fiduciary standard, and as a result, I am legally required to act in the best interest of my clients. If you are using a commission-based broker, that broker can only provide what's known as investment education and only receive compensation in the form of revenue sharing or 12b-1 fees that is built into the cost of the mutual fund expense ratio, and that is not considered legally to be advice. So if you're a young attorney and you are working for a company where the company does offer a 401k plan, there are various important questions to ask. The first question is if the employer offers a match. And if the employer does offer a match, regardless of the investment options, it is always a good idea to contribute at least as much as the employer is offering so you're not leaving money on the table. However, sometimes, depending on the investment options, it's best not to contribute more than the match. And that leads into the next question is what investment options are offered. It's very important to ask your employer a specific list of the investment options, including all of the service fees, which consist of record keeping, administration, custodial, mutual fund, and advisory fees. And it's very important to understand specifically what those advisory fees are for, how those advisory fees are being provided, and how each of the service providers are earning their compensation. In many cases, the service fees are significantly excessive, and that's why it's so important to understand what you're paying. In fact, according to the Department of Labor, if you are 30 years old with a $25,000 balance, and you earn 7% for 35 years, assuming a fee of 0.5%, you will accumulate a balance of up to $227,000. Whereas if you have simply an additional 1% in service fees, your balance will only be $163,000, which is 28% less and $64,000 less just because of that 1% in fees. So it's very important to understand those details. Furthermore, it's also important to know if you have a Roth 401k option in addition to the traditional 401k option. The reason is that with the Roth, you can also accumulate your investments on a tax-deferred basis, which means that the investments do not get taxed as the investments grow. However, you are funding the account with after-tax dollars. And what that means is that you do not get a tax deduction. However, upon withdrawal, you will not pay taxes and you will not be subject to what's known as required minimum distribution rules, which means that with a traditional 401k plan, you are required to pay taxes starting in the year following the year that you turn 70 and a half. However, you will get that tax deduction upon making that contribution. The question is, what will tax rates be in the future and which is better? If you're a young attorney and you're in a low tax bracket, there can be advantages to the Roth 401k because of the fact that taxes might increase significantly in the future, and when you withdraw, then you will not be subject to any taxes. Consequently, it's best to engage in tax diversification and split the money up between the Roth and the traditional, where you can still contribute up to $18,000 in total between the Roth and the traditional 401k. With regard to attorneys who are at a firm that does not offer a retirement plan, it is best to consider both a Roth and an individual IRA, where the contribution limits in total are $5,500 a year. Once you've made that decision, it's important to decide how you want to invest and what type of approach you take, whether it's actively managed, meaning that the mutual funds charge a management fee where the fund manager actively buys and sells securities in order to outperform the market, versus a passively managed approach where the fund manager simply tracks what the market is doing. I won't specifically recommend one approach over the other, but compare it to blackjack, where unless you're a very sophisticated player, it's very difficult to beat the house. And I will conclude by explaining that rather than focus on which investments that you need to choose, it is best to focus on three factors which have a much greater impact on your wealth than which investments you choose. And that is when to save, how much to save, and when to retire. To quantify this example, the difference between an optimal portfolio and the average portfolio, with the optimal portfolio being 100% stocks, which over periods of more than 30 years always will outpace inflation and will always outperform the other asset classes, which are bonds and cash. To quantify this difference, the difference between an average portfolio and an optimal portfolio is simply working 4 extra months before retirement. So to conclude, it is much better to develop a formal investment plan that subjects you to certain criteria where you will decide when to save, how much to save, and when you retire, because that is what will affect your retirement the most.